Welcome to EWA's FIN-LYT podcast. EWA is a fee-only RIA based out of Pittsburgh, Pennsylvania. We hope all listeners of this podcast will benefit as we deep dive into complex financial topics that we will make simplified for you. And we hope that this really serves as a catalyst so that you can make the best financial planning decisions for your family and also save time. Welcome, everyone. Today's episode, I'm joined here by Jamison Smith. We're going to be talking about the current underweighting in mid and small caps. We're recording this in August of 2024. We've always maintained, asset allocation, diversification. However, during different economic cycles, how we asset allocate it is very important to navigate, certain times. So, Jamison, start off by giving just what's the history of these different asset classes as it relates to today's discussion.
Yeah, so we'll primarily focus on U.S. large cap and U.S. small caps, just to give a general overview at a basic level. Large caps, obviously, like the large companies in the U.S., your Amazons, Teslas, Apple, companies everyone knows. They're huge. They've been around for a long time. Small cap would be smaller companies that aren't obviously as large yet. So looking back at history, the last 100 years, they've performed pretty similarly, but small cap has won by a little bit. So since 1926 to 2023, small cap has been between about 11 to 12% rate of return. Large cap has been between a 10 to 11% rate of return. So they perform differently in different economic cycles, which we can take a deep dive in, and why we're obviously, like you said, recommending more of a tilt towards large cap. But one of the big things is just generally large cap stocks are more stable, more profitable, less volatile, whereas small cap, there's a lot more volatility and risk. So you could see some more upside, but it's important to know you're taking on a lot more risk to get some of that upside.
Absolutely. Well, the risk is obviously measured in standard deviation, and the standard deviation is essentially volatility. So when small caps are good, they can be really good. When they're bad, they can be really bad. And it could be, catastrophic if you're overweighted in a really bad period. So, tell us. So, give us some recent examples, like 2000, 2010, post 2008, and then 2020 and beyond. What are some of the recent data that we've seen? Yeah,
I'd say in general, so any type of bull market, large cap stocks generally, or small cap stocks generally outperform. So the last 15 years in the U.S. from post 2008, 2009 financial crisis up until COVID pandemic, and then 2024, large caps really crushed it. Small cap has outperformed in the bull markets. In any type of volatile market, recession, large cap's going to win generally. Reason being, smaller companies. So if we look at the climate of the last couple of years, high interest rates, small companies generally rely on lending from banks, raising capital from investors. A lot of time the investors are borrowing money. So it's much harder to get money when the interest rates are high. As well as any type of recessionary period, which haven't been in a recession, but if people are spending less money, inflation's higher, less people have jobs, smaller companies could suffer more, whereas the large companies have, a lot of cash on the balance sheet. They're highly profitable. They're able to shift and navigate and withstand some of those times. But to your question, looking at time periods, basically post dot-com bubble 2000, 2010, small cap stocks outperformed large cap. A lot of that was due to these tech companies were really on the up and up, and these small companies took off, and obviously some of the tech companies made it. Post 2008 to, like I said, to now, large cap has outperformed, and then 2020 and beyond. Basically, there was COVID-19 pandemic in 2020, both dropped significantly, and then large caps generally will recover faster. And so there's a big rebound in small cap stocks 2021, but in general, they've been fairly stable. Obviously, we're favoring large cap right now, but I think one of the things to note is if you were to look at the S&P 500 index, there's going to be less, not all five, even if a year where the S&P 500 goes up, not all 500 companies are positive. There's obviously
not even close.
A portion of them are negative. What's interesting is when you look at like a small cap index, there will be, I don't have data to back this up, but I'm guessing there's going to be more companies that are at a loss because you have these companies like, think of like an Uber, for example. You may have that 1 or 2 or 5 that like explode, and they're going to make up for the growth of all of those losers. So there's just more volatility and more uncertainty in the small cap space.
Yeah. So just to put a high level reasoning on why we are where we are today. So like on average at EWA, if you were in like 100% equity portfolio, we would have, typically, maybe 60% large cap, 12% between mid and small. So over 2/3 of the portfolio would be in the U.S. and the other, less than 1/3 would be, international, between international developed, international emerging. Right now, currently, we're 65% in large cap and only 5% in mid and small. So we're about half, a little bit less than half of the position we'd typically be in mid and small. And the high level reasoning behind that is in large caps, we still see huge earnings per share growth, like 18.9% year over year. And in small caps right now, it's negative year over year. So there's a lot of reasons behind that. But I would say if I were to give, 1 or 2 reasons, it would be what used to be very easy money and what people would call like free money out there has totally changed. A lot of these small companies, banks aren't going to give a small company a loan, like quickly like they would have a couple years ago. And if they do, that loan's going to be, maybe at a 7% rate instead of a 3% rate. And so when we're talking in like hundreds of millions of dollars, a 1% difference can be huge. A 3% difference could be, a cash flow going from positive to completely negative overnight. So with that being said, we see a lot of small and mid companies, they're just not able to post profits right now. They're in the red, and we continue to see them in the red until some headwinds change.
Yeah. Why don't you give like a current, if we were to look at the current economic situation now, what's going on, and then kind of we'll pivot that into why our portfolios are how we have them.
Yeah. So, I mean, the other thing too is when you look at really good small companies, if you look at all companies that are private, small companies that are private, in 87% of firms that have a revenue greater than $100 million are private right now. And out of these firms, they actually are 80% of job openings. So if you look at just like the S&P 500, for example, that's 18% of the total U.S. employment. So private sector looks for a lot of, so if you look at like, you're a small company and you're wanting to grow and grow and grow and eventually get public, you may miss that small and mid cap stage of being a publicly traded company and go right to market as a large cap company. Or we're seeing that often because it's just easier to get when private money, someone that really believes in your company. It's typically huge investors, and it's a lot easier to get like money from a couple people than it is to be public and have to post results every quarter and having all the pressures. And
a lot of the your valuation, it's just all public image, so it's all whatever shareholders think of you, all like whatever the public thinks. That's way harder to do that than be private, and you worry about the business owners, your company itself. It's just a totally different landscape. Can be much more difficult.
Absolutely. Yeah. I mean, it's quite outstanding. So I mean, we're still big believers in small and mid companies, but as far as like a lot of the quality companies, they're private right now. And a lot of the quality companies in the large cap are actually in a quality focused investment in the large cap, where we're focused on the top 25% quartile of profits, of cash in the balance sheets. Because with 49% of the world at vote this year, not just the U.S., companies need to have the flexibility to, if politics are going to, like a political change and affect an industry, you need to have the ability to be flexible and change that. And small and mid companies we see with negative earnings, when you have a negative cash flow, it's very little flexibility, if zero flexibility for not able to continue to grow cash. So we don't see this changing in the near future. We do see, as we go through cycles of early, mid, late, and then, recession, these factors can change, and we may go to the fact where we go back to normal, even heavier in small and mid cap over that typical 10 or 11% between the two. But for right now, we're at about half because of these reasons. So, well, James, any other useful data that you'd want to point out?
Yeah, so I think it's huge that there's some political uncertainty around the world, like you said. Not that we're worried about who gets elected and what's going to happen with the market. Just these companies have to be able to shift based on policy changes.
Yeah, the S&P 500 is made up of all these different healthcare, financial, tech, all these different sectors. So on top of looking at just the factors we're in, I mean the difference of what makes up the S&P 500 versus small cap. Jamison, talk to us about that.
Yeah, I think it's interesting right now. There's more 65 people over the age of 65 than under the age of 15 for the first time in history. We're obviously about to see a huge wealth transfer with after World War II, the baby boomers. A ton of people were born. Now those people are retiring. They're post 65. 85% of the wealth in the United States is held by people over the age of 65. So if we look at what are those people going to spend money on, healthcare is a big one.
Absolutely.
Technology obviously is a huge driver right now with AI and a lot of things that are going on with tech. And so if you look at these indexes specifically, large cap is generally made up right now, is more heavily weighted towards tech, healthcare, consumer discretionary, things that kind of play into that thesis of where the wealth's at and what that money's going to be spent on.
Yeah, whereas rich people are going to spend on healthcare and discretionary.
Yeah.
And retirement. I mean, those are two. They have to spend on healthcare and discretionary. They have the means to, whereas younger generation won't have as the means to do that.
Yeah, exactly. And then the small cap indexes right now are have higher exposure in financials, industrials, energy, and those are things that are more cyclical. So I think bottom line is it's impossible to tell what's going to actually win in what time period. Bottom line is, be diversified. We can shift and tilt slightly based on macroeconomic trends. We never want to put all our eggs in one basket and say, okay, we're going all large cap. It's going to crush the next 10 years because reality is nobody really knows. You want to have that diversification. And the interesting thing too is, especially with the smaller companies, that can flip really quickly. These small cap companies are more volatile, so they could just take off in the next year.
Yeah, if these factors that we're talking about change, then this isn't a flip. We're going to focus. Interest rates go low, we're in a recession, now we're suddenly going to go back into a bull market, then we will want to favor the small and the mid.
Yeah. It's important to not totally jump ship and avoid either of these completely. Be diversified and make sure you have all your baskets filled.
Absolutely. Well, thanks for joining us. Jameson, thanks for joining us as well, and we'll catch everyone next week. Thanks for tuning in to our podcast. Hopefully you found this helpful. Really hope this is as beneficial and impactful to as many people across the nation as possible. So hit the follow button. Make sure to rate the podcast, and please share with any friends or family members that would also find this beneficial. Thank you very much.